And we are now recording.
Okay, great. Thank you. Well, welcome everyone, and thank you for attending today's hearing. My name is Kathleen Bahrain, and I serve as the Maryland Insurance Commissioner. This is the Maryland Insurance Administration's first public hearing on specific carrier rate increases for long-term care insurance in 2021. And today's hearing will focus on several rate increase requests now before the MIA. In the individual long-term care market, these include requests from Provident Life and Accident Insurance Company, which originally filed increases of 57.2% to 193%, depending upon the inflation coverage option benefit period and previous 3.8% landing spot election. And by Genworth Life Insurance Company, proposing increases of 101% for all policyholders, except those policies that were issued to people age 70 or older, or policies that do not have inflation. In addition, Riversource Life Insurance Company is not proposing to increase rates, but they have filed for new benefit reduction options for policies already in force. Combined, these requests affect about 8,498 Maryland policyholders. The goal of today's hearing is for representatives from Provident and Genworth to explain their reasons for the rate increases they've requested, and for a representative from Riversource to explain the new benefit reduction options. We will also listen to comments from consumers and other interested parties. The MIA is here to listen and ask questions of the carriers and consumers regarding the specific rate increase requests. Before we get started, let me take a moment to introduce the people who are here with me from the Insurance Administration. First, we have Todd Schweitzer, who is our Chief Actuary, David Cooney, the Associate Commissioner of Life and Health, Adam Zimmerman, Actuary, Jeff G., Senior Actuary, and Craig I., the Director of Communications for the MIA, is here. And if you have questions or any technical issues and you're able to access the chat function, you can, of course, say that to everybody, but you can also message Craig separately, particularly with any technical concerns. So let me just take another moment and go over some of the procedures that we're going to follow today. First, when it's time for public comments, we will call first on the members of the public who are registered to speak in advance. If you didn't RSVP, but you still would like to speak, that's okay. Just use the chat window to alert us. And when you ask to speak, use whatever name you would like to see appear in the transcript. To the extent that time and technology permits, we will call on you and unmute you so that you can speak. Second, with the exception of MIA staff, this hearing is not a question and answer forum. So comments from interested parties were received and reviewed in advance of the meeting. And Todd Schweitzer will give us a very brief high-level overview of the key elements of those public comments by interested parties. The MIA will continue to keep the record open until Thursday, May 27, 2021 for additional written testimony or comments. The transcript of today's meeting, as well as the recording, will all be posted on the MIA's website on the long-term care page. The long-term care page can be found at the MIA's website by clicking on the long-term care tab, which is located right under quick links section on the left-hand side of the homepage. So as a reminder, and as you heard a few seconds ago, we do have a court reporter on the line today to document the hearing. So when you're called to speak, please start by saying your name and your affiliation clearly for the record. Please spell your last name for the court reporter's convenience. To ensure excellent sound quality throughout the hearing, we ask that you please stay on mute unless you're speaking. Okay, so we will ask the carriers to speak first today regarding their filings, and we'll call them in just A to Z order. And afterwards, interested stakeholders will be invited to speak. And now I'm going to turn it over to Todd Schweitzer, who has a few comments to make.
Good afternoon. 7 Maryland consumers submitted public comments, and we're appreciative very much of those comments. And a few quotes from them as I went through them stood out. And a couple were, I purchased this policy for peace of mind and security against the infirmities of old age. It's not right that after 2 decades of premium increases, I haven't secured a policy that I can keep for the rest of my life. Another was that options and costs shouldn't be negotiable at this time in one's life, meaning over age 65. And then a last one was the increases are gigantic, extraordinary requests to the point that they're not insurance anymore. So we figure all these in, and it led me to want to communicate some of how, when my team and I review these rate filings, what the outcome is, how we figure this in, how we figure in keeping a stable, financially viable market in. And in the filings that we looked at in 2020, the average approved loss ratio was 111%. And let me explain that, please. 111% loss ratio means that for every dollar of premium over the life of the policies, we've asked the carriers to pay $1.11 in claims. So absorbing expenses. And also in that number, when these policies were introduced in the early 80s, generally the intention was to have a net income of a positive 25% of net income. And what this 111 that we've approved equates to a negative 25% net income. So sharing the burden of what's happened here is implicit there, and wanted to make that known, and also share that some of the things that we consider are multi-year rate increases to dampen and spread costs over multiple years, not 15% after 15%. We've approved 10, 7, 5, etc. To exempt thin benefits like 2-year benefits or no inflation benefits, to exempt policies with very low enrollment. We've approved less than half of what has been requested of us in recent years. We insist that investment income be brought into the modeling in addition to claims and expenses. And we've raised the ideas of having a ceiling on how much a premium can increase over the course of a policy. We've looked at states like Washington State that's instituted a state plan with a base $36,500 benefit. We don't look at the policies piecemeal, just the filing in hand. We look at the whole block that a carrier has. We ask for rate locks to have some respite from rate increases a year, where after increases have been implemented, but there's no increase the company commits to for a year or two. And lastly, we've asked for delays during the pandemic, to, even if we approve something, to wait on implementation. So in closing, we're trying to seek a balance. And on the one side, from the consumers, I think from the insureds rather, a way to communicate. And one of the consumers' question was why, and we do want to try to convey why. Major carrier that had a high capital and surplus of in 2015 of 3.8 billion, and as of 2020, that's 2.1 billion. So a 44% decline. We attend the earnings calls. We try to keep an eye on that thing, on that metric rather. And on the other side, the consumers. One of the filings in front of us proposes to raise a premium ultimately from $1,500 a year to $16,000, tenfold. And that's why what I relayed a few minutes ago, we have cut back, and we've resulted in the loss ratios we've conveyed. So our hope is that these meetings, we know there's a long way to go to make things better for all parties, and we hope that these meetings generate ideas and dialogue that help make things better. Because again, I know the problems remain, to state the obvious, and we're trying to attack them with diligence and earnestness. So with that, I'll turn it over to my colleague, Adam Zimmerman.
Thank you, Tom.
Thanks, everybody. My name is Adam Zimmerman. I'm an actuary with the Maryland Insurance Administration. And I just want to apologize in advance for having my video off. Prior to this call, I ran into some technical difficulties where my video is lagging significantly. And so for everybody's sake, I've just elected to turn it off. But prior to hearing the testimony on behalf of the companies today, I just wanted to discuss 3 items. The first of which will piggyback off of what Todd had just talked about regarding rate approvals. The second one is the standalone long-term care marketplace in Maryland in 2020. And then just a few items related to COVID-19 and its impact on long-term care. So to begin, in 2020, as Todd pointed out, we looked at 44 we reviewed and approved 44 long-term care rate filings with an average lifetime loss ratio of 111%. And these 44 filings impacted approximately 50,000 Maryland policyholders. As initially filed, the average request between all of these filings was for a 70.4% rate increase, and the average approval granted was for a 31.4% rate increase. For those that may not be aware, Maryland does have a long-term care annual rate cap of 15% in their regulations, and so any approval that was granted over 15% would have been phased in over multiple years, as Todd was relaying in his comments. Because due to these approvals, the end-all result is approximately $49 million less in premium increases than originally sought. When looking at every impacted policyholder, if the full rate increase requested was approved compared to what was approved, the difference is approximately $49 million for Maryland policyholders. Similarly, so far in 2021, 8 long-term care rate filings have been approved, impacting approximately 23,500 Maryland policyholders. As initially filed for these 8 filings, the average request was for a 95.8% rate increase. Average approval was for a 28.4% rate increase. And again, any approval over 15% would be phased in over multiple years due to Maryland's annual rate cap. The resulting approvals granted results in approximately $46 million in less premium increases than originally requested from the carriers. Moving on to the state of the market. In 2020, there were 13 companies that were approved to sell individual standalone long-term care insurance products in Maryland. And from the annual statements that were submitted earlier this year, it's estimated that there were approximately 1,094 new policies issued in Maryland between these 13 companies for the standalone long-term care market. One thing we wanted to highlight is that we are continually monitoring the market dynamics between the standalone long-term care insurance marketplace and the hybrid long-term care insurance marketplace. For those that may be unaware, a hybrid long-term care insurance product is one that's purchased alongside life insurance or an annuity product, in which long-term care benefits can be used should a policyholder require one. And then finally, the impact of COVID-19. We'll talk briefly about that. Currently, the long-term impact, and so by long-term, I'm referring to 5-10 years into the future, of COVID-19 on long-term care rates remains uncertain. However, generally speaking, in the short term, throughout 2020, long-term care experience data has shown increased mortality rates for policyholders in nursing homes, and in addition, slightly improved morbidity rates, either because new claims were delayed due to fear of entering a nursing home or assisted living facility, or new claims originated at home. In the short term, this has resulted in improved financial performance for companies offering long-term care insurance. For companies seeking a rate increase, the MIA is requiring carriers to quantify how this improved experience and reflect it in its projections offered in support of their rate increases. One thing we want to point out is that long-term care insurance is usually held for decades. And so as such, in the long term, as more people become vaccinated for COVID-19, it remains uncertain how future experience will develop. In general, 1 or 2 years of improved claims experience may not be enough to offset the multiple past losses of poor claims experience that long-term care insurance carriers have seen. Additional considerations for COVID-19 on the long-term impact include, but are not limited to, as more people become vaccinated, will claims incident rates converge back to normal levels? Will we continue to see a shift in claims towards home care as opposed to nursing home and assisted living facilities? If so, will this require a greater demand for home health aides? And if there is a greater demand for home health aides, could this result in increased hourly wages for home health aides, which could potentially increase the cost of long-term care services rendered in a home care setting? For the first few months of 2020, during the lockdowns, doctors' visits were often forgone. And so has this delayed care as a result of COVID exacerbated health problems, which subsequently caused policyholders to become eligible for long-term care benefits today, who otherwise would have been, who, if they would have attended their doctor regularly, who would have caught this diagnosis and potentially delayed the onset of long-term care benefits being needed. And finally, for the for the COVID long haulers, how did the long-term effects of COVID impact a person? Is a COVID long hauler more susceptible to requiring long-term care services in the future? As claims experience develops for COVID in the long-term care setting, hopefully some of these answers will become more clear. But one thing is that the MIA will continue to monitor this claims experience as it develops. So with that being said, I wanted to turn it over to the commissioner, who will call the first company to provide their comments.
Thank you, Adam. I think both you and Todd have done an excellent job of trying to contextualize, how it is that we consider these filings, how we have traditionally processed them, the considerations that we bring to bear and the balance that we're trying to reach. So as we move forward, as we consider the rate increases that are currently before us, we want to give the companies the opportunity to articulate the bases for those increases. As I said, this is not interactive for anyone other than the MIA, but our actuaries will articulate their questions with regard to the filings on this presentation. So let's start with Mr. and I apologize if I mispronounce your last name. Is it Jaso? Jaso?
It's Jaso.
Jaso, okay, with Genworth Life Insurance Company. So Mr. Jaso, if you would just introduce yourself and your position, and happy to hear your presentation.
Sure. Good afternoon. My name is Matt Jaso, spelled Jaso. I'm a director in Genworth's long-term care insurance business. Commissioner Bahrain, thank you, and the Maryland Insurance Administration team for holding today's virtual hearing and for providing Genworth, our policyholders, an opportunity to discuss our long-term care insurance policies. I'd also like to thank all of the policyholders for your interest and participation. Genworth understands that your long-term care insurance coverage is important to you, and so we welcome this opportunity to participate in today's hearing. During this unprecedented period, Genworth understands our ability to support, service, and protect you, our policyholders, is of absolute importance. We take this very seriously and confirm our commitment to being there for our policyholders when they need us. Genworth has been selling long-term care insurance in the state of Maryland since 1978 and currently provides coverage for approximately 29,000 Maryland policyholders and approximately 1.1 million policyholders nationwide. I'm here today to speak specifically about our current long-term care premium rate increase filing, which is pending with the Maryland Insurance Administration. Genworth understands how difficult premium increases are for our policyholders, so we are committed to providing information that explains why rate increases are needed. We also want to discuss the various options we offer our policyholders and the ways we assist each of you to make informed choices about your specific LTC insurance needs. Genworth is currently seeking rate increases on an individual product issued between 2002 and 2005. When we priced this form, we utilized professional actuarial judgment to develop assumptions that looked as long as 60 years into the future. Genworth employs our best efforts to complete a thorough professional assessment at the time of original pricing and as we evaluate the blocks on an ongoing basis. Since 2010, claim information has more than doubled for Genworth. We have seen that claims continue to cost more and occur with higher frequency than originally anticipated. We are sensitive to the impact these rate increases have on policyholders, and Genworth is sharing in the cost of these rate increases. Genworth has suffered approximately $3.6 billion of losses on LTC legacy blocks cumulatively through year-end 2020, and will continue to experience significant losses on these lines of business. We have stated that we have no intention of ever taking a dividend out of the companies that hold these policies. These blocks of business are being managed solely for the benefit of policyholders, and these rate actions will go directly to support the claims paying ability of the company. It is our intent to act in a timely manner, work diligently with regulators to obtain approval for the proposed rate increase, and seek to avoid more significant premium rate increases that would otherwise be required when the average attained ages are higher. I also want to highlight some of the COVID-19 related considerations that have impacted the long-term care industry and Genworth. Given our industry, we are uniquely positioned to understand the devastating impacts of COVID-19 on some of the most vulnerable in our communities, older adults. Considering our average claimant is in their early 80s, we appreciate this particular population is at high risk for contracting and suffering serious effects from the coronavirus. Genworth implemented a comprehensive COVID-19 community outreach plan to assist those most challenged in our communities. We initiated outreach to local nursing homes and assisted living facilities and created programs to respond to social isolation among seniors. In addition, the Genworth Foundation has made contributions to safety net organizations in the communities in which we have offices, many of which provide care and services to the elderly. As a global organization, Genworth has created and maintained business continuity plans across all of our businesses. Despite the changes we have made to our operations in light of COVID-19, careful planning has allowed us to continue the operation of critical functions, including policy administration, and most importantly, payment of policyholder claims. Overall, Genworth has observed what was believed to be a temporary decrease in new claims, potentially due to reluctance that some policyholders feel about moving into facilities or having somebody outside come into their home and take care of them. Publicly available information indicates that this is an industry-wide phenomenon. We believe that incidence is likely to return to pre-pandemic levels in the future. In addition to a temporary decrease in new claims, COVID has also accelerated a shift from facilities to home care services. We believe this increase was induced by concerns over well-publicized COVID-19 infection rates in LTC facilities. Now, although we are seeing lower incidence and shifts to home care services, recent home care experience metrics show higher benefit utilization for those newer claims relative to historical levels. While the ongoing impact of COVID-19 is very difficult to predict, the related outcomes and impact on our LTC business will depend on the length and severity of the pandemic and speed of economic recovery. There is significant uncertainty as to the long-term impacts of COVID on overall morbidity and on the health of the general population. We have not changed our long-term assumptions based on recent COVID experience. We continue to track business performance to help refine our expectations, but it remains too early to tell how recent trends may impact longer-term financial results. LTC is a very long-term product, and we project premiums and claims over a 60-year period. Events in any given year, while tragic in and of themselves, are unlikely to materially change overall projections for the future. Genworth's #1 goal is to ensure our claims paying ability for all of our policyholders. Actuarially based premium rate increases or equivalent policy adjustments are an important component to achieving this over the life of these policies. As it relates to the specific rate increase requests at this time, Genworth issued Choice 1 policies from April 2002 to October 2005 under policy form number 7035. We are seeking premium rate increases of 101.1% for policies with issue ages below 70 that include a benefit inflation option. Acknowledging Maryland regulation, Genworth would be willing to implement the requested rate increase over 5 years with no more than a 15% increase in each year. This rate increase will impact approximately 5,700 Maryland policyholders. Impacted policyholders have had cumulative rate increases of 101% for policies with lifetime benefits and 98.5% for policies with limited benefits. On the Choice 1 product, the objective of Genworth's multi-year rate action plan is to get closer to a break-even point. This plan has remained largely unchanged as the rate increases continue to be pursued. In the future, we expect to file for additional rate increases on this product above the specific request we're talking about today. We will not make money on these policies. As such, we are absorbing a significant share of the cost of deteriorating claims experience. We understand that these premium increases can be a tremendous burden for our policyholders. We know this because we talk to our customers every day. To support our policyholders, we have a dedicated team of specially trained customer service representatives whose sole responsibility is to take calls related to rate increases. Our customer service reps are ready and willing to help our policyholders understand their options so that they can determine the best course of action for their individual situation. We also have information on our websites that provides policyholders with additional information on why increases are needed, options they may have, the value of coverage, and frequently asked questions. We continue to offer policyholders subject to a rate increase a variety of options. They can choose to pay the full amount of the rate increase and maintain their current level of protection. From our overall nationwide experience on the rate increases we have implemented since 2012, even with the variety of options provided, we have seen approximately 62% of our policyholders choose to pay the higher premiums. Or instead of paying higher premiums, our policyholders can make custom benefit adjustments to find the right balance of affordability and protection for their individual situation. For policyholders who no longer can afford or want to pay any future premiums and who do not otherwise qualify for another option to maintain the policy while ceasing to pay premiums, we voluntarily offer a non-forfeiture option that equals a paid-up policy. With this option, if the policyholder becomes claim eligible, Genworth will reimburse eligible expenses up to the amount of premium paid, minus any claims that we previously paid. In addition, a policyholder would still have access to the care coordination services that our company provides. With a full approval of the rate increase requested, Choice 1 policyholders would be offered our new lifetime stable premium option, which has been submitted for approval to the Maryland Insurance Administration. This option is designed to have a reduced but still meaningful set of benefits and provides the stability of a lifetime premium rate guarantee. This new option is the product of our commitment to designing all innovative solutions for policyholders facing substantial rate increases. For many policyholders, the lifetime stable premium option will significantly mitigate the impact of the rate increase, provide meaningful protection against an LTC event, while also providing certainty about future rates with the lifetime guarantee. At this time, I also want to acknowledge that Genworth is currently implementing a class action settlement that generally applies to Choice 1 policies. Under the terms of that settlement, certain Choice 1 policyholders will receive a special election letter with options to reduce their policy coverage, and some of these options may also include the opportunity for a cash damages payment. These policyholders may choose one of the settlement options or may instead choose to keep their coverage unchanged. Our specially trained customer service team will be available to assist our Choice 1 policyholders with questions regarding the special election options. The settlement and special election options are not part of a rate increase and are completely separate from the pending rate increase request for this policy form. I hope the comments today have demonstrated that Genworth actively manages our business to try to ensure that we'll be here for our policyholders when they need us most. To make sure we are available to provide the answers you need and to pay eligible claims if and when those needs should arise. To date, Genworth has paid over $22 billion to our policyholders on more than 300,000 claims for eligible long-term care benefits. Genworth is committed to keeping our promises to our customers and paying all eligible claims. Again, actuarial-based premium rate increases or equivalent policy adjustments are an important component to our ability to do so over the life of these policies. Genworth is in a unique position relative to other carriers with a material LTC concentration. Almost 60% of our total reserves back LTC liabilities, and that amount is projected to increase to 65% by 2023. Any reserves that are released due to policyholder elections, including elective terminations or reductions in benefits, are used to support the LTC business. As I previously noted, GLIC does not intend to use any capital or collected premium for anything other than supporting the claims paying ability of the company. The company has not contributed any dividends over the past 6 years to its parent companies. The last dividend was paid on August 31st, 2015 in the amount of $7.5 million to Genworth Holdings. Genworth Financial has publicly informed its investors on multiple occasions that it assigns no value to Genworth Life Insurance Company, as management does not anticipate that Genworth Life Insurance Company will pay any future dividends to its parent companies. You may also be aware that Genworth terminated the merger agreement with Oceanwide on April 6, 2021. As we publicly discussed before, the strategy for managing the LTC in-force business and need for premium rate increases does not change with or without that transaction. In conclusion, Genworth remains committed to working with the Maryland Insurance Administration to implement actuarially justified rate increases in a reasonable and responsible manner, keeping in mind policyholder interests and concerns. Commissioner Bahrain, Genworth appreciates the opportunity to participate in today's hearing, and I'd be happy to answer any questions from you or members of your team.
Thank you. I do have a few. I'm going to ask a few high-level questions. And I'm sure my actuaries will have much more detailed questions, but just a couple of points I wanted to clarify. So you indicated that the last dividend that was issued by Genworth to its parent was paid on August 31st, 2015. So there haven't been any since 6 years, but obviously there were dividends that were paid prior to that time period.
Yes, yes, there were. That's correct.
And do we have any concept of what that would amount be? Let's just say in the 2000s, these policies were issued starting in 2002, correct?
Yes, yes. The rate request we're talking about today is on the policies issued in 2002 and 2005.
Right.
Commissioner, I actually do not have that specific dividend information, but we can certainly follow up on that.
I'm not sure how critically important that full detail is, but I guess what I want to highlight is the fact that during the period of time that these policies were in force and premium was being collected, there were dividends that were being paid. I appreciate and I applaud the decision not to pay any further dividends, but the company was taking dividends, approving dividends for its parent up until 2015.
And I would just kind of add to that is that while that is true, with long-term care, experience continues to develop, and we're kind of learning new information as time goes on. And so specifically since 2014, we have made some significant updates to our assumptions, which aligns with the decision to stop paying those dividends.
Sure. And we could probably have all kinds of discussions about, when companies became aware that its actuarial projections were not as strong as they thought they were to begin with, in terms of even before these products came out. The other question that I wanted to ask about was, I just want to make sure that I understand the terms, is that you had indicated that you wanted to get closer to a break-even point so that you're not making money from the products at this point in time. But are you, and this goes back to, and Todd can say this in a much more articulate manner than I can, but as you were listening to Todd and to Adam talk about sort of what our objectives have been and the idea of what is the company's, piece of absorbing. So for example, the average at the MIA being that for every dollar received in premium, the company is paying out $1.11, so that there is not just a break-even point, but there is actually partnership on the part of the company in terms of sharing the burden of the unexpected changes in experience. And so along those lines, perhaps you could share with us, and perhaps specifically with respect to this book, where you would be on that continuum.
Yeah. So as I mentioned in my prepared remarks, we've had significant losses on our legacy blocks, including this particular policy form. We have lost money on a cumulative basis. Going forward, we expect significant losses on this block as well. And so we're looking for the rate increases to help reduce those future losses.
So I don't think that was exactly the answer to my question, but this may be one where you have to take it offline to give us that number, or Jeff and Adam may ask questions better than I do along those lines. And, one of the things that obviously we want to understand is what goes into your equation. So when you're looking at what you consider the expenses you're absorbing versus what you roll into, where the premiums are applied, I think we want to make sure that we have clarity about that. But I'll leave that to the actuarial team, who will say that in a much more articulate way than I can.
Well, thank you for your questions.
You're welcome.
I did have a question, and first, thank you. And my question has a preamble, and it's this, that we've noticed that with first quarter 21 financial statements, that the capital and surplus of the legal entity grew by 200 million, which is good to see, starting to get to strengthen. We also have seen and have heard from your CEO and others on the earnings calls, 8 consecutive quarters of long-term care positive earnings. And when you even roll in long-term care with life insurance and the fixed annuities, the last couple of quarters have been the best that we've seen in years, sadly for reasons that we have talked about earlier. Thirdly, as you alluded, we've seen a shift from facility care, where in Maryland, the average cost a year is about $122,000, to home care, where the cost is closer to $55,000. 55% more pronounced cost reduction in Maryland than nationwide, which is more like a 42% decrease. I know we've asked you to sensitivity model that shift from facility to home care, and the thought of counter pressures to that, negating potentially that utilization shift we're in the middle of talking about. So with that, my question is, I heard you say that you've not changed our long-term assumptions based on COVID. It's too early to tell. And my question is, so have the beneficial financial impacts that have been observed so far, have they been projected to be completely offset in the future?
Yeah, Todd, it's a very good question. You're right. We have had some profits over the last few quarters, and as you mentioned, it is that COVID has been absolutely devastating to older Americans. Going forward, we really do not at this time have any reason to change our long-term expectations from COVID. We are monitoring it. We want to make sure we understand what's happening. Long-term care, as you know, is very complicated, and there's lots of different assumptions. And so, for instance, we're seeing people are going on claim today. Some of the newer claims, while those incidents are down, and maybe there are more on happening in the home care side, the benefit utilization is actually higher. So there's lots of offsetting impacts, and we're still, like I said, monitoring that and looking at it. But right for the moment, it's not really changing our long-term projections. And at the moment, we would still expect to have really, significant losses going forward over time.
Thanks. And to speak to the commissioner's point, one thing we will discuss with you further after this is, with the request that you've made of us for rate increases, you've modeled for us various scenarios, and if we were to grant theoretically what you've asked for, we would see a lifetime loss ratio of 89%. And our thought was, we know that the long-term plan is for 15% increases, and our thought would be that this current subset of those 12 increases would get to 89. We think that the more 15s after that, many more, would get it down below 85. We see 85 as break even. So just interested in those numbers and just an advance notice of where our next iteration might be as we try to work with you on these.
Yeah, so I know our next round of our MyRAP, I think is planned for, roughly 75% on lifetime, and it's in the 50% range on limited. I don't know exactly what loss ratio that has, but you're correct about the current offering or ask would be around 89 or 90% loss ratio.
Thanks.
This is Jeff G from the MI. My question is to follow up the commissioner's question. Can you give us a clear definition of the break-even point mean? So we can have a better idea of that.
Yeah. Well, I think overall with the break even, so generally these products were priced at roughly 65% loss ratio. So we're not really trying to get back to original pricing. We know on the loss ratio, it's you're including premiums as well as claims, but there's other things that are not factored in. It's hard for me to say exactly a certain percentage, but we're certainly not trying to get back to pricing. It's something south of 100%, but ultimately it's to the point where we're trying to reduce the losses as much as we can without really making profits.
Okay, so currently you are asking for 101% rate increase. So after that, do you expect more rate increase requests in the future for this block?
Yes. Kind of as I mentioned to Todd, there is another round after this particular one.
Can you disclose how much more rate
I believe
increases?
the next round is roughly, I think, I don't have the exact numbers, but it's roughly 75% on the lifetime and in the 50 to 55% range on the limited.
Okay,
but thanks. I don't have those exact loss ratios in terms of what that relates to.
Thank you.
Okay, any other questions from any member of the MIA staff? Well, in that event, thank you very much for the presentation and for your answers to our questions. Obviously, the rate request is under review, and I know you've had several conversations with Todd and his team, and I appreciate for your engagement in the process and for your testimony today. Thank you.
Thanks for the opportunity.
So I will now invite Jake Lucas and John Lemoyne from Provident Life and Accident Insurance Company. If you gentlemen could introduce yourselves and your position, please remember to spell your last name.
Great. Thank you, Commissioner Brain. Can you hear me? Great. My name is John Lemoyne, Lemoine, and Jake Lucas is with me here today. We're appearing on behalf of Provident Life and Accident Insurance Company, which is a member of the UNUM, UNUM group of families. So first of all, we do want to thank you, Commissioner Brain, and the other members of the staff of the Maryland Insurance Administration for holding this hearing. And we thank each of the folks who are listening in or participating today. I am an assistant vice president and legal counsel for UNUM's Closed Block Operations Business Unit. UNUM's Closed Block Business Unit is comprised of products that UNUM no longer markets, including our long-term care business. With me on the call today is Jake Lucas, who is UNUM's Chief Long-Term Care Pricing Actuary, and he is also in our Closed Block Business Unit. A bit of history may help set the groundwork for our comments today. UNUM exited the long-term care market, the individual long-term care market in 2009, and exited the group long-term care market in 2012. The vast majority of our LTC policies were issued between 1989 and 2012. UNUM has over 900,000 long-term care insureds nationwide, including approximately 4,000 Maryland individual LTC policyholders and approximately 12,000 insureds covered under group long-term care policies issued to Maryland employers. As context for today's hearing, this pending rate increase is focused on our block of Maryland individual policies written by Provident Life and Accident Insurance Company that were sold from approximately 2003 to 2009. Under that block of policies, the total number of Maryland policyholders who would be impacted by this requested premium increase would be approximately 500 insureds. We at Unum take our commitment to our long-term care policyholders very seriously. We have a team of over 180 LTC professionals dedicated to providing customer service and administering benefits. Our top priority is to meet our obligations to each of our customers, including providing benefits in their time of need. In the year 2020, we paid over $667 million in long-term care benefits nationwide and over $14 million in long-term care benefits to Maryland insureds. Another priority of ours is to manage all of our insurance products to ensure the financial stability of our operating companies, both for the short-term horizon and for long-term sustainability. This is extremely important, not only for our LTC policyholders, but for all of our policyholders. When Unum entered into the LTC business in the late 1980s, we determined our prices using the best data available at that time, applying assumptions and predictions about how future experience would develop. Unfortunately, like many in the industry, our actual experience in the years and even decades since we issued those LTC policies has turned out to be significantly different than the actuarial assumptions used to set original prices. These developments include individuals covered under long-term care policies are living longer and holding on to their coverage longer than anticipated, leading to more claims being made than had been originally projected. Also, once individuals are on claim, they are staying on claim longer than expected. And at the same time, investment earnings on the reserves we hold to pay claims continue to be significantly lower than originally projected, given the sustained and historically low interest rate environment. As a result of the combination of these factors, our long-term care block has suffered significant overall losses. In 2006, when the financial reality of Unum's LTC business started to become more clear and credible, we filed our first LTC rate increase to mitigate financial and enterprise risk. Our goal in the LTC rate increases we have requested on these individual policies is not to generate profits, nor to recoup any of the past losses we have experienced. Instead, the rate increase requests on these policies have been aimed solely at moving these policies to a point of self-sustainability on a go-forward basis. We want to ensure that our reserves plus premiums for these policies will be sufficient to pay all projected claims and expenses. With that in mind, the rate increases we have requested nationwide on this block of individual policy forms represent only about 37% of the amounts we could ask for as justified under the actuarial requirements in place when these policies were issued. The rate increase amounts we have requested in this filing vary depending on whether the policy provides a lifetime benefit duration or a more limited benefit duration, and whether or not the policy's benefit amount includes inflation increases. These requested rate increases reflect the results of our most recent actuarial analysis of our actual and projected experience and include amounts remaining outstanding from our prior rate increase requests that were limited by annual rate increase caps applied by the Maryland Insurance Administration. We understand that the Maryland Insurance Administration typically limits rate increases to a maximum of 15% per year. As with our prior rate requests, if the administration applies such a cap to this request, we will continue to seek increases in the future for the amounts that our actuarial analysis indicates are necessary for these policies. We also note that we will continue to monitor and evaluate the experience of our long-term care business over time, as we are charged to do under regulatory and actuarial standards. If experience develops adversely to our most recent projections, we may need to return to Maryland in the future with additional rate increase requests. As an example of how we actively review and evaluate our experience, we are monitoring and analyzing the impact of the COVID-19 pandemic. And first, we want to acknowledge the human impact of the pandemic, which has been so sad and profound. Second, when we look at the impacts of the pandemic on our long-term care block from an actuarial perspective, which we are obligated to do, we have seen some near-term elevation in mortality in our claimant population and some near-term volatility in the level of claim submissions. For a product like long-term care, where claims experience develops over years or even decades, it is essential for us to analyze these trends over the longer-term horizon. We believe that these near-term trends will normalize and that our pricing assumptions over the long-term horizon remain valid. And as mentioned, we will continue to monitor how experience develops over time. Returning to the rate increase request before the administration today, we would point out that even though we are seeking less than what is actuarially justified, we at Unum do recognize that long-term care rate increases may present many of our customers with a significant challenge in maintaining their coverage. Unum's policyholders have the option to adjust various coverage features on a go-forward basis to reduce the level of their premium, either in response to a rate increase or to manage affordability generally. Depending on the provisions of the policy itself, these adjustments may include reducing the monthly benefit amount, reducing the benefit period, changing or dropping inflation coverage, increasing the elimination period. And also, in conjunction with Unum's long-term care rate increases, we provide each of our impacted policyholders with the ability to select a non-forfeiture option where the policyholder may choose to no longer pay premiums going forward, but nevertheless retain LTC coverage in an amount equal to the total premiums paid by the policyholder on that policy. We at Unum believe that no LTC policyholder should surrender coverage as the result of a rate increase, and we believe that these options offer reasonable alternatives to our insureds at various levels of affordability. In closing, we acknowledge how difficult LTC rate increases can be for our policyholders, and we continue to serve our customers as effectively as possible by offering reasonable options to manage affordability, by providing quality service during the life of the policy, including, most importantly, at the time of claim. Thank you, and we'd be happy to answer any questions you may have.
Okay, thank you very much. I appreciate the very thorough presentation. And again, I think that my actuarial team will have their own questions. I guess my real question for you is, what is the lifetime loss ratio for this book, assuming your rate increase request was granted? What would that be?
If the full rate increase was granted, it'd be 97%. And we kind of, as John mentioned, we're seeking, self-sustainability going forward. And that wouldn't quite get us there, but it at least gets us to where we're covering the claims.
And when you're doing the calculation and you're looking at what self-sustainability means, do you bake in things like investment income? Do you bake in expenses?
Yeah, expenses are included, and the benefit of investment income is included in that analysis as well. So from a loss ratio perspective, we'd be looking probably between 85 and 90 for a break-even point.
Okay. Thank you. Todd and
That's
Jeff.
Todd, and my question was, when you mentioned that the rate increase that you've proposed is 37% of what could be requested, what was actuarially justified when policies were issued. Does that mean to get back to original profitability, please?
That would be based on the loss ratio requirements at that time. So yes, it's getting you back to profitable status.
Okay, thank you. And you said you're monitoring COVID. Can you relay the last several quarters? Has your experience been consistent with others that it's favorable for long-term care specifically?
Yes, it has been, with the higher claimant mortality, and we've actually seen lower claim submissions during 2020. And we did see an
Sure.
uptick in claim submits in the first quarter of 2021. So maybe going back
Thank
towards
you.
normal levels, yeah.
Okay, this is Jeff. My question is, I heard you said if the MIA applies the 15% to the rate requested, you will continue to seek increases in the future for the amounts that are that you actual analysis indicates are necessary. So my question is this the same method you use for all your filings? For example, December 2019, MIA was not able to fully approve what you originally requested for the other two filings. So are you going to seek increases for those two, those forms in the future too?
Yes, we will. We'll be filing later this year for those two forms.
Okay, thank you.
If there are no other questions from anybody at the administration, then I will thank you, gentlemen, very much for the presentation and for the answers to our question, and the dialogue will continue offline.
Thank you very much for your time today.
Thank you. And last, we will hear from Charles Caswell from Riversource Life Insurance Company. Riversource is not seeking a rate increase, but is seeking approval for a different option, an additional option for its insureds who wish to reduce their premium or not have a premium increase go into effect because they've made adjustments to the policy itself. So, Mr. Caswell, if you would let us hear your thoughts with regard to your filing, appreciate it.
Can you hear me?
I can.
Great. Good afternoon, everyone. My name is Charles Caswell. I'm Vice President and Actuary at Riversource Life Insurance Company. I'd like to take this opportunity to thank the Commissioner and her staff for providing this opportunity to participate in this important hearing. Thank you also for providing this forum for Maryland citizens, including our valued policyholders, to express their views and comments on these filings. I'm here today to talk about the 3 long-term care rate filings we submitted on March 1st, 2021 to the MIA. These filings are for the purpose of offering new benefit increase options, that is perhaps better understood as inflation options. We would like to make available to owners of certain long-term care policies on 3 separate blocks of business that were sold in Maryland between 1993 and 2003. The impacted policies are subject to premium rate increases filed to the administration on April 24th, 2020, that are currently being implemented over a period of 2 or 3 years, depending on the block. We began implementing these premium rate increases on policy anniversaries starting in October 2020. In addition to the 3 rate filings for the new benefit increase options, we also submitted a separate form filing on March 1st, 2021, which includes endorsements to be used with each block of business to support these new inflation options. Please note that these policies provide richer benefits than many policies sold today. For example, over half the policies have lifetime benefits, and about 96% of the policies offer some sort of benefit increase option. I want to be clear that we are not seeking to change premium rates from previously filed levels for any existing policy, for any existing benefit options as part of these filings. Rather, we believe it is in our policyholders' interest to have more options to choose from when considering how to respond to a premium rate increase. I'd like to discuss our existing benefit increase options and then describe the new options we are seeking to offer. At the time a policy was originally issued, the insured had the choice to elect no benefit increase option, the 5% simple benefit increase option, or the 5% compound benefit increase option. The 5% simple benefit increase option increases the daily benefit amount by 5% of the maximum original daily benefit amount each year. The 5% compound benefit increase option increases the previous year's maximum daily benefit amounts by 5% each year. And as you would guess from the title, the no benefit increase option provides no increases after issue to the maximum daily benefit amounts. The new benefit increase options we would like to offer include a new 0% simple benefit increase option, which will be available only to those policyholders who currently have a 5% simple option. The current daily benefit would be locked in at the current level with no future increases, but with a lower premium cost. A new 2% compound benefit increase option and a new 0% compound benefit increase option, which would only be available to those policyholders who currently have a 5% compound option. For policyholders electing the 2% compound option, the current daily benefit would increase 2% a year going forward instead of 5%, but with a lower premium cost. Note that all increases in daily benefit accrued from the time of issue until the time the new 2% option, compound option is elected would be retained. For policyholders electing the 0% compound option, the current daily benefit would be locked in at the current level with no future increases, but with a lower premium cost. The premium reduction from currently filed premiums for these new options varies substantially by the issue age of the policy. However, the 0% simple option would average about a 15% lower cost than the 5% simple option, with a range of about 3% to 30% less expensive. The 2% compound option would average about 25% lower cost than the 5% compound option, with a range of about 6% to 46% less expensive. And the 0% compound option would average about 38% lower cost than the 5% compound option, with a range of about 10% to 63% less expensive. Across the three filings, there were, as of December 31st, 2019, 724 Maryland policyholders with a 5% simple option and 1,428 Maryland policyholders with a 5% compound option across the three blocks of business in which we're filing these options. Since November 2020, we have submitted filings for these new benefit increase options in 16 states, focusing on states in the middle of a multi-year premium rate increase implementation. 13 states have reviewed and accepted these filings with no changes to our originally submitted premium rates. And these filings are pending in the other 3 states, including Maryland. We are launching these options in 2 states for anniversaries starting in April 2021, in 8 more states starting June 2021, and in 3 states in July 2021 or later. Eventually, we hope to offer these new options in every state. We would like to initially offer these options to eligible Maryland policyholders at the time of the second year of the multi-year rate increases currently being implemented. That is, starting with policy anniversaries in October 2021. We previously communicated to each policyholder the premium required to maintain the current coverage for each year of the spread premium rate increase. We will also send out a premium rate increase notification letter about 60 days in advance of the effective date of the second and, if applicable, third years of the increase, reminding policyholders of the new level of premium due and providing premiums for several alternative benefit reduction options, hopefully, including the new options we're proposing here. Thus, we want to start mailing these letters with the new benefit increase options to Maryland policyholders in early August 2021. And in order to have our systems updated to be able to offer these new options to impacted policyholders, we hope the premium rates for the new options and the corresponding endorsements can be accepted by the administration by the end of June 2021 or shortly thereafter. We're eager to work with the administration to be able to offer these new options to our policyholders, as we believe some of our policyholders will find these new options to be very beneficial. Thank you for the opportunity to speak today, and I'll be happy to answer any questions you may have.
So Mr. Caswell, thank you very much. I myself do not have questions, but let me turn it over to Mr. Schweitzer and Mr. G to see if they have questions.
Yes, thank you, Mr. Caswell. When we had spoken about this previously, you meant that you saw this as a better than option than landing spots, that it's more equitable. Do you mind expounding that a bit, please?
Okay, I will be speaking extemporaneously here, so, and I'm an actuary, so just warning you. The reason is that someone who's younger, traditional landing spots tend to get the same reduced inflation increases going forward for every policyholder in exchange for not increasing the premiums as part of a rate increase. However, that's not necessarily equivalent to what somebody is giving up. So someone who is currently age 70 might have 20 more years of increases that they're giving up. And someone who is currently age 90 might only, unfortunately, have a few years of increases that they're likely giving up. And yet we're changing the inflation amount each year in a traditional landing spot by the same amount. We've chosen a different path, in part because we want to try to be a little more equitable on that. So younger policyholders would see a larger premium reduction than relatively older policyholders, because the younger policyholders on average are giving up many more increases in the future, or reducing or have lower increases for many more years into the future than an older policyholder. Does that answer your question?
Thank you. It does.
This is Jeff. My question is, so what percent of the related policyholders you assume would take this new benefit reduction option?
It's hard to know because it's new. In the past, when we have offered things like shortening benefit periods or reducing daily benefit amounts to help mitigate the impact of an increase, roughly 5% of people have done each of those. So maybe 5%, and these are very round numbers, but 5% of people have reduced benefit periods, and 5% of people would reduce daily benefit amounts. So we don't know. We think this has value. It might displace some of those other decreases, but our best estimate right now is that about 5% of people would choose one of these options. But again, we don't know. It might take off. We have very, very, very early evidence that, from the effective dates in April, that it's starting off a little slower, but I also think our financial advisors aren't as familiar with it yet. So far it's running a little under 5%, but it's very early, and I'm reasonably confident it will grow to be 5%, maybe a little more. But it's new, and I'm not aware of anyone who has offered multiple inflation type options to in-force policies that weren't originally filed at the time the policy was sold. So it's kind of a different kind of thing, but we think we've addressed benefit period reductions. We've tried to address benefit amount reductions. This is the one area we haven't really tackled in terms of trying to provide options.
Okay, thank you very much.
Okay, if there are no other questions from the Maryland Insurance Administration team, then I will thank you, Mr. Caswell, for
Thank you.
Your comments today and your explanations. And as is the case with others, the conversation will continue. So at this point, I am going to do two things. The first thing I'm going to do is, we'll hear from each person who signed up, who RSV'd and signed up to testify. We will also remind people that if you wish to speak, to be heard online, then please let us know. Put your name into the chat room, and Mr. I will unmute you and give you the opportunity to speak toward the end of the hearing. Also, there have been 2 people who have either made comments or asked some questions. We're not going to take questions today, but what I do want to make sure of is that these comments get into the record. So at the end of these comments by those people that RSVP'd, I'm going to read those comments in. And with respect to the second chat item, the questions that are embedded in there, as I said, we're not going to address those today in this hearing. However, what I would ask that individual to do is to, in a private chat, if you would private message Craig I with your contact information, then we will get back to you. So if you, whether you're comfortable with a phone number or you're comfortable with an email, but please do that privately. And then we will make sure that we reach out and have conversation with you about your specific circumstances and questions. So with that, let me first recognize John Roach, if Mr. Roach would like to speak today.
Mr. Roach isn't in the audience at this time.
Okay. How about Howard Benjamin?
Howard Benjamin is not as well. I can't find Howard Benjamin in the audience.
Pat Gebhardt?
Again, not seeing Pat Gebhardt.
If you are under somebody else's name and we're just not recognizing you, then please raise your do something in the chat room that lets us know that you're in fact here. Let's see. Bill Wants.
No, again, I'm not
I
seeing
thought I
Bill
saw
Wants.
I thought I saw among the attendees.
The attendees, no, not seeing
A Bill Wants. Looks like he's dropped off.
Yes.
Okay. All right. And then finally, Marshall Fritz.
Mr. Fritz, can you hear us?
Yes, can you hear me now?
Yes. Excellent. Thank you.
Okay, so I have no video of myself here, but you'll hear me. Is that correct?
That's correct.
Okay. I want to make a comment on what Commissioner Moraine just mentioned about the private note to Craig. I just hit chat because I had questions based on the testimony so far, and I can either do all panelists or all panelists and attendees, but I don't have any other options on my.
Okay, I apologize for that. That is my lack of Zoom technical skill. If you provide anyone who provides their contact information to all panelists, that will only be disclosed to literally the people whose names you see on the screen, as opposed to the all attendees. And when we publicize, we provide access to the recording here. We just want to be very thoughtful about people's public information and contact information. The other thing that we can do is, Craig, if you want to advertise your email address and make sure that people have that, if folks are more comfortable reaching out that way, we'll do that. But it's really whatever you're comfortable with. We just want to preserve your privacy and your contact information to the extent that you don't want that public.
Okay, so that's fine. So I will, once I get a contact for Craig, I will send some questions based on the testimony so far. And that will either get into the record or at least the staff will think about these questions. Is that correct?
So 2 things. First of all, you are welcome to provide any comments that you want verbally today and in writing. And those comments will absolutely be available to everybody to see on our website. Secondly, we are very, very happy to talk to you individually and to just both hear your questions about these filings and also answer any questions that we can help you with regard to how they might impact you personally.
Okay, well, can I I have prepared testimony, which would be about 10 minutes running, the way I rehearsed it. But can I ask some of these questions so that I think they're general questions that could be of interest to every attendee. So can I ask them now since it's not personalized?
So we have until 4 o'clock. No, we have time. So let me try to ask you to be a little bit more succinct in 10 minutes. And we're not going to go into a question and answer session, so we're not going to answer questions. But if you feel that it's important to state them and you want to state them verbally now, I will hear them.
Well, then I will try to write to Craig or staff if I get a contact on the new questions. Okay.
Yeah, and let me just say it
You
out
might-
loud. It's Craig, so you can see his name on the screen, Craig I. It's craig.iey@maryland.gov. And that's true of everybody who's on this screen right now that works for the Maryland Insurance Administration. So,
And that is now in the chat as well.
Okay.
and it's in the
Okay.
chat.
IEY. Craig.iey, correct?
EY.
Just EY. Okay.
Yes, sir.
Yes. Okay. Thank you very much.
You're
Okay.
very welcome.
So let me start and I'll see if I can. Okay. My name is Marshall Fritz and I'm a 2003 long-term care Genworth policyholder with the inflation protection. I've done 2016-17 testimonies and I resubmitted for the record what the communications were back and forth back then. I'm concerned, especially because the letter I got from Genworth first said that they were justified with 160% increase. And then a month ago, I got another letter saying, no, I'm sorry, it was really 315% increase were justified. And there's no explanation of the discrepancy, even though they say that the actuarial statistics were justified for the new rate, okay? But I'm worried that because this is so high and far away from the justifications that they claimed in 2016 and 17 of 48 and 75% respectively, that it just seems like it's accelerating without reason over a 4-year period, well beyond any of the trends of the recent past. So this needs examination clarification. Let's see. In my the response I got to the 2017, there was a lack of discussion on administrative expenses, reserves, and how these affected calculate premiums. As we've talked before, that the 15% doesn't quite catch up, but I understand that now. And rate stabilization is a difficult term because we're not stabilizing at the moment yet. So I am concerned about 15% increases on infinitum. If I were to live to 100 independently, I'd be paying a premium of maybe $400,000 a year. And of course, that's of concern because it's well beyond the economic value of probable long-term care at that point of what I've paid in. Let's see. Well, the gentleman, Mr. Yasso, mentioned that basically the Genworth LTC have been a loss to the company and dividends have been cut. But I don't know how much a company like Genworth should move assets from other divisions that fare well to a division that's losing. And that was mentioned in NAIC reports decades ago. And as I said, it's not clear about administrative costs and staff if they're fairly allocated to long-term care, and maybe the actuaries know this better, but it's not obvious to the consumer. let's see. I'm concerned that the policy conversion rates, according to what I read from Genworth bulletins, make it sound like they incorporate the already justified rates. Well, if they're saying they can justify 100, 200, 300% increase, wouldn't that mean that a conversion downgrade could cost more than keeping your policy? So that's a question that needs clarification because it's only written in very few words in the material I've received. Let's see. We've talked about the COVID situation, but medical costs and medical inflation before the COVID situation have remained low, and that should have helped rates recently. Even if interest rates in the reserves is negligible, they should balance to some extent. So I'm, let's see. So I'm, with all due respect to what the commissioner has said, the intentions are, and the staff and Mr. Jasso, I am concerned about what's happening to the rates long-term. It's not just 15% for a few years. It looks like it's indefinite unless some kind of stabilization agreement is come into place, as Mr. Jasso suggested there may be. I'm just adding to the concern other consumers have had. So the numbers that I heard today, as I mentioned, my letters have said 160, 315 justified increases, but it sounds like it's only 100% discussed as a request. And I don't understand if it's justified, why it's not requested. And when Adam had mentioned that 28% versus 75% or so was approved, well, I don't know the pockets of the disallowed amounts to understand what's not being accepted. But the numbers don't quite jive. And going forward with the justifications, how that enters from Adam and the actuary perspective, how that goes into the future requests that come back from Genworth. In other words, the disallowed amount, does it come back in next year, or it's X'd out and as being disallowed? So that's something that I can't know from today's discussions. Let's see. Also, the class action settlement from court from Genworth, is it published somewhere that we can find out? We won't tell us the new plan, but it'll tell us the court citing. Let's see. So okay, so that's the gist of what I put in, and I put into my testimony basically what I was going to talk about, and it's on the record that I sent in to the staff yesterday. Okay, so that's basically what I wanted to say quickly, probably about 5 minutes.
Hey, Mr. Fritz, thank you very much. We do have your testimony. That will be posted if there are additional comments that you want to add. I think in terms of a number of your questions, there is some context that our folks would be able to provide to you, and if you reach out to them. Todd, let me just ask you for some of the bigger, broader points that Mr. Fritz has referenced, if you or Jeff or Adam just want to hit at a really high level some of those questions around, the difference between actuarially justified, really the question that you guys were asking around, actuarially justified, assuming, a break even versus assuming the original. Maybe you could provide some sort of high level discussion around some of those points that Mr. Fritz has asked, and then we'll obviously follow that up Mr. Fritz, give you the opportunity to do a deeper dive with some of these concepts offline.
Yes, thank you. Thank you.
I apologize, Lena. I've had problems and I didn't catch all of what you just said.
So if you were able to hear, I know we've all been having some technical glitches here. My
I'm sorry, I
connection is
can't.
unstable as well.
I'm gonna have to
That's okay.
go out and in again.
That's
Can't
okay.
hear you.
Adam or Jeff, were you able to hear Mr. Fritz?
Yes. For your question, actual justified, right? To me, first assumptions is should be sustainable. So, for example, investment income, mobility, and then the claim frequency. All those assumptions either actually sound reasonable, and also another way is in compliance with the our Maryland regulation, that kind of thing. For example, oscillation wide, we have 85, 58, 58 testing, either meet that. So that's high level, in my opinion.
So I think, Mr. Fritz, you're going to need that tutorial offline to get into kind of, sort of that level of detail. Todd, you're back on. I don't know if your sound is any better at this point. Okay, it doesn't look like it. So, Mr. Fritz, I'm going to apologize for the technical issues. Adam, I don't know if you had any comments you wanted to make.
The only comment I would make with regard to one of the questions that was raised was the whole difference between what was approved and what was asked for.
Right.
So if they request, I don't know, just as an example, 50% and the approval is a single 15 or 30, over multiple years, to address the question of are they phased out or are they not, it truly depends on the company, because ultimately what happens is, if they come back and they say, oh, last year you disallowed a 20% rate increase, as an example, that was, we requested 50, you approved 30, so you disallowed 20%. Some companies may come back and say, our experience has deteriorated, and based on our new assumptions, we can justify X, whatever that X is. Or some companies may come back and they say, our new assumptions justify X percent, plus, there's a backlog of rate increase that wasn't approved for whatever reason. So we're adding that into the new request as well.
And then it goes through that same rigorous process again.
And correct. It goes through the same review, of course, experience based on the new, a year, 2, 3 years later, however long it's been since the previous rate increase, the experience will have changed from the previous rate increase. So then it's reviewed again, see how it compares to the previous year. Has it deteriorated? What assumption changes there were? Do the assumptions justify whatever rate request they're seeking, et cetera?
Okay.
Thank you, Adam.
If a
Todd,
certain
is there anything
amount
you
is
wanted to say?
disallowed, in the current application, let's say an administrative cost center, not a claim, benefit claim, then when they come back in the future, they can argue future administrative costs, but the ones that you disallowed that were such like administrative costs, are those permanently disallowed from the past applications?
So the rate increases, when they're looked at, they cannot recoup, or we will not allow them to recoup past losses. What's in the past is in the past. So if a company's agreed to a lower rate increase that's been if they, in my example, if they requested 50 and they agreed to 30 because of, the 111 or 110, whatever target loss ratio, but they've agreed to, if they lose money because of that, because of expenses or interest rates being lower than what they assumed, they can't say, oh, we should have made $20 million extra in the last 3 years, and because you MIA disallowed this rate increase, we're reseeking that additional $20 million. No, that can't happen. It has to go on a look forward basis with the experience that's left, and the projected expenses, projected claims, and projected interest rates based on current assumptions.
Thank you. That's clear.
Okay. Todd, was there anything you wanted to add? Okay, still technical difficulties. So is there anybody else who is an attendee who wanted to speak?
Teresa has her hand up. Commissioner,
Do you want to
let's unmute her.
allow her in?
Can you hear us?
We can't hear you, Teresa. Do you want to unmute her?
Yeah, she's unmuted.
No, it still shows up on mine as muted.
Yeah, I'm asking to unmute now.
Okay.
Okay. Yeah, she has to unmute herself at this point, so. But she can speak. She has the ability.
You may have to unmute yourself, Teresa.
Hi, thank you. I'll just follow up in my email to Craig. But I appreciate all the comments that Marshall made. He's obviously much more aware of what's going on, but I have similar questions to follow up on the letter that I received from Genworth concerning the price increases, because when I see something that talks about a 198% increase over 3 to 6 years, and I hear from you that the state of Maryland won't allow for anything more than 15%, I'm not that good at math to reconcile those comments.
Now, I understand what you're saying. And so, again, if you reach out to Craig, then he will connect you to the right person on our team who will be able to hopefully explain to you, help walk you through the letter. And to the extent, if you have questions in context, we're happy to spend time with you on that.
Okay, thank you.
And this is Adam Zimmerman. The only thing I will say to follow up on your comments is that yes, there is a 15% rate cap in Maryland for any policy that was issued in Maryland. The annual rate increase cannot exceed 15%. So yes, I can understand the confusion if you're receiving a letter saying they're seeking, whatever they're seeking, 100 and something percent. So we will definitely have somebody look into that for you.
Thank you.
So what I'm going to do for the record, and if you want to speak, just let Craig know or raise your hand or send up a flare and we'll unmute you. But I want to read the comments that are in the comment box. And I know we've heard a little bit, but let me read them into the record. So the first is from Maddie Sharp. And the comment is, hello, my name is Maddie Sharp. I sold many GNW LTC policies in Maryland between 2002 and 2015. The rate increases are horrendous, but not surprising given the low cost of the policies at the time of sale. I am on the phone a few times a week speaking with clients about rate increases. Even with the rate increases to date, I still believe the price is fair given the probability of needing care and cost of care. My issue, and where I'd like to get some confirmation from GNW, is what assurance do the policyholders have that GNW is going to be there in 10, 20, 30 years, and when it's time to make claim? Will GNW be able to pay these claims? If I felt comfortable knowing that GNW will be able to continue to pay claims for the long haul, I would be much more confident in encouraging my clients to pay the rate increase. So, what we won't do today is go into sort of a back and forth debate about solvency and guarantee funds and sort of those kinds of safety nets and the long-term picture for Genworth. But I know that you've provided your contact information in the chat room, and we will reach out to you, Ms. Sharp, and discuss with you, your questions and like sort of some of the framework to the extent that we can help you with that. The next comment was from Teresa, who we did also hear from. And I think you have articulated to us, but I will read the comment in nonetheless. My March 9th, 21 letter from Genworth refers to 376.320% increase for lifetime benefits over the next 3 to 6 years, and 198.680% increase for limited benefits. Please reconcile this with what I just heard about your increase requests. Also, I've already been told by Genworth that my next annual bill to be paid this fall will be 13.49% more. When was that increase approved? Finally, am I correct to understand that if I don't opt to change my policy by 6/6/21, that I need to either live with the current policy and increases or forfeit the policy? So I will let my actuarial team respond now to the question about the timing of any rate increase that you're seeing in your policy. I think that the last time that we had a rate increase approval, but on a broader sense, let's get you, as we said, connected with someone on our team that can really walk you through the specifics of your policy. But for the most part, just at a very high level, it's not a binary thing. It's not a pay the increase or forfeit the policy. Carriers have tried to craft out options to not have you lose all benefits under the policy or lose the coverage under the policy. But there are places where you could decrease certain elements. You could increase the amount of time before you can file a claim after you're eligible for a claim. You could decrease the cost of living type increases that are in the policy. There are a set of variables or triggers that you could toggle in order to keep the premium low or where it is now, or not feel the full impact of the rate increase. And then, of course, the other piece of it is the non-forfeiture piece, which is that if you ultimately decide that you are just absolutely not going to pay any additional premium, the premium that has been paid to date minus claims is still there and available to pay future claims. So it's not a forfeiture of the policy if you don't make another premium payment. So that piece I did want to mention. But again, we'll look forward to talking to you individually about the letter you've received and what that means with your particular policy and your particular policy form. The only other comment I see, I think, is from you, Todd, that you're having, because of your technical difficulties, you're only hearing a small portion of what's being said.
Right.
Yeah. Are you able to hear? Are you able to speak now?
Yeah, the last 5 minutes have been okay.
Okay. So if you just want to, articulate any other comments you want to make based on what you've heard, I won't read your chat.
Sure. Well, I apologize up front if I'm off point, but I'm trying to speak to Mr. Fritz's comments. And the first thought was, when we have filings that come in with a request and we approve something less, what's behind that is the thought that the carriers believe that their lifetime loss ratio, if I could speak in those terms, generally should be below 100%. And our thought is that partnership and that sharing of the burden should be a little more than that, more sharing by the company up to 111%. That's kind of how you can translate why we're approving less. Also, when I mentioned that proposing that a premium of $1,500 will ultimately go up to $16,000 is not something we find tenable that leads to that. So those things are wrapped together. And another related thought was that recently in a phone call with a carrier, they asked us, well, of the 50 states, you're in the bottom 10 of what you've approved. Can you please comment about that? And we want to be cognizant of the best approaches, best methods of our partner states and our neighbors. However, in the end, we're tasked with serving Marylanders, and we try to be transparent and clear and vet everything that we do and support what we're doing. So being in the bottom 10 is something we're aware of, but again, we're trying to serve Marylanders the best way we can, and being there is something at 111 that we find to be the best balance. So there's a lot in that, and we're happy as a team to follow up with you, Mr. Fritz. We appreciate your thoughtful comments after this, but I hope that's a start.
Thank you, Todd. I appreciate that. Anybody else who is an attendee who would like the opportunity to be heard today?
Ms. Sharp has her hand up.
Great, you want to bring her in?
I will.
Hello, can you hear me?
We can.
Hi, I'm Maddie Sharp, and Commissioner, you did read my comments, and I appreciate that. But I just want to follow up on something that you said. When I was alluding to the solvency of these insurance companies to be able to pay the claims in the future. And I do think that for the most part, that is the crux of this issue. To throw good money after bad is very, very problematic. And again, if I could tell my clients, because I can justify the current prices, I don't know what the future holds, but I can justify the current rate increases with respect to risk, probability, et cetera. But if I'm having these clients pay these large rate increases for a company that is not solvent, I think that's a huge issue. And you do mention that many states, like Maryland, do have a guarantee fund. To my knowledge, that guarantee fund is limited to $300,000. And many long-term care policyholders have benefits well in excess of $300,000. Maryland is one of the most expensive places in this country for assisted living and nursing care. And while $300,000 may sound like a lot of money, it's not enough for the average claim, which is typically 3 years. So I do think solvency of the company is ultra important in these discussions.
Well, it's very important to us as regulators. And, you know, I've represented before I became insurance commissioner, long-term care companies, including long-term care companies that unfortunately became insolvent. And it is a very, very difficult issue. There are some companies that get so far out of whack that there's not really much that you can do about that. And every regulator has that as a top of mind consideration. And that is our balancing test. We are constantly balancing the need to make sure that companies have the surplus, have the money that they need in order to make sure that claims are paid and paid timely, against also the consideration of what makes sense for the policyholder. That's why the approach that Maryland takes is a very surgical approach. We look very, very carefully at, you know, what the company is able to absorb in terms of sharing part of and partnering in part of the losses that nobody anticipated. So your comments are spot on. You know, I'm very familiar with Penn Treaty. I'm very familiar with SHIP and the circumstances, you know, what's been occasioned by that. That doesn't mean that when companies are taken into receivership because they're insolvent, it does not mean that those companies immediately go into liquidation and into the guarantee fund. You know, a company like SHIP, for example, that was continued in business in a solvent runoff for a period of time, and then was under supervision for about 2 years, and then is now in a rehabilitation proceeding, there are requests and that are contemplated to increase premium during rehabilitation. So it's not, again, a completely binary situation, but you are absolutely correct that the answer isn't that companies become insolvent and we can't just rely on guarantee funds. While it's different from state to state, some states are as low as 100,000, some states have no cap, one state has no cap, and then the average is 300,000 or 500,000. So I thank you for those comments, and it's because it's important to point that out because that is a real concern.
And as we monitor that type of information, it was good to see Genworth in the first quarter to go up by 200 million in capital and surplus and have a 30+ point increase in their risk-based capital. Try to keep a close eye on those things.
Was there anybody else who is an attendee who wanted to be heard today?
Not seeing anyone else in the chat. No hand
I
raised.
think I have read all the comments in. So if there is no one else who's indicated that they want to speak, I'll just give one last opportunity to the folks at the Maryland Insurance Administration. Is there anyone on my team that has anything that they would like to say as we close off? Okay, well, with that, again, we will hold, oh, Mr. Lemoyne, did you want to speak?
No, thank you. Just thanks to the administration for your hard work. These are challenging issues and we appreciate the opportunity to speak and to hear today. Thank you.
You know, and I think what we see is the balancing game that everybody has to play. You know, I mean, you know, Maryland is, as I said, pretty surgical, and that's why we're in the bottom 10%. But we are very, very mindful of surplus and RBC and what it means for companies to go into receivership and to go into liquidation. Nobody wants to see that happen. That's the other side of the coin. And I think, you know, Maddie is smart to make sure that her clients understand that that is a balancing act. Because getting to her point, $300,000 at the end after having paid all that premium is frankly, it could be a much worse result than, you know, the increase in premium. But Todd's team looks very carefully and tracks surplus along with, you know, our E&A unit in looking at, you know, the status of where companies are. So we will hold our public comment period open until next Thursday, the 27th. So if you have additional written comments or testimony you want to provide, please do so. And if you have questions or comments for any of the members of my team, you have Mr. Todd's email address, and you are welcome to send him an email with your questions, and we will reach back out to you and try to answer those questions. So with that, I thank everybody for their participation today, and we can close this one out. So thanks and stay safe.